Hi everyone, welcome to our latest webinar on how to trade the markets. Welcome to the proptrade.com. It's Tuesday, the 10th of June 2025. It's been relatively quiet market day today. We the ongoing ongoing, I hate that phrase. Does anybody else hate that phrase like I do? Ongoing doesn't actually mean anything, does it? But US China trade talks continue. It was only scheduled for one day yesterday, Monday the 9th. It's rolled over into the second day. They're still talking, which is always a good sign. Stock markets have sort of been lifted on the back of that. But we'll see actually what comes out. It's all in the nitty gritty as ever with these trade talks. But let's see what comes of that. Tomorrow is obviously the big day today. We've got inflation, CPI data out of the US tomorrow. So we'll be live for that data. So Monday, we had a look at part two of our scalping strategies, 5 scalping strategies out there. If you've got any questions, please stick them in the box as ever on the chat panel. Send me a message on Discord, send me a friend request on Discord, or send us an email directly at theproptrade.com. And tonight we're going to look at market gaps. So welcome. There's lots of market gaps. People say they're always filled. Lots of them are filled, and they're not the ones we're interested in. There can be some really powerful moves after a market gap because it's telling us something. It's telling us something when a market moves without, filling a price action. It just moves to another level, whether it's up or down. It can be very, very significant in the things that cause it. So we're going to have a look at 4 or 5 setups for that, 4 or 5 patterns, say some good, some not so good, and how we can benefit from that as traders. But as ever, it's all about managing your risk. So let's crack on. We've got an hour or so. Hopefully this won't take as long as an hour, but let's see how we go. We don't want my big bald head there. Do we move that around? There we are. Slides are a wee bit bigger now. So how to trade market gaps. So let's have a go. Those of you that are new to the proptrade.com or have not seen me before and on my other online events or live seminars, my name's Stuart. I'm head of education here at the proptrade.com. My background is in the City of London. I work for a big national bank and an international, a big international Swiss-based outfit as well. I ran my own management consultancy for a while, particularly on the telecom side of things. I moved myself and my family to Cyprus for a different way of life at the beginning of the 2002. I did a few jobs, and I moved back into the world of finance around about 2013, 2014, something like that. 2013 it was. I was a part-time teacher for a little while, but anyway, enough about me. My approach to trading is really, and investing has always been the same thing. Keep it simple. Understand the time frame you're investing or trading in. Don't get scared. Don't get too cocky, and keep probability on your side. Always do what is probable and keep it simple. It's all in the numbers. So if you understand things like margin and leverage, if you're trading, derivative accounts, it's really important what margin means, what leverage means. But fundamentally, the most important thing is that highlighted here: know yourself. It's all about your mental capacity to accept losing trades, to accept winning trades. To know the difference between the two, to accept and close the losing trades, to accept and close the winning trade. Don't let them go too high. Excuse me, my nose is a bit itchy. I've just had a late day shave, which is never a very good idea, is it? You should always do it first thing in the morning. But anyway, enough about me. Let's crack on. So today we are going to look at what market gaps are, the different types, 4 or 5 types, 4 classifications of market gaps. And then we look at the really powerful one, which is the island reversal. So really 5 setups, and see if we can find any live examples. It's certain markets tend to gap more than others. The forex market, you tend not to see many gaps. When you do, they can be very significant, as with everything. It's a bit like looking for divergence with your technical indicators. Divergence doesn't occur that often, but when it does, it can be very, very powerful. So same with market gaps, and the island reversal, for instance, it doesn't occur that often, but when it does, it can be very powerful and really help you, keep probability on your side again as well. So, as I said, they don't occur very often. They occur a lot in the stock market, in indices, individual stocks. So, lots going on potentially. Somebody's messaging me. Okay, very good. Let's crack on. So any questions, please stick them in the box. So gaps, the definition out of the, I think it's Investopedia. I think I got this. Sometimes referred as windows. That either an empty space on the chart. So you might have your candle pattern or your line. Actually, with a line chart, you don't really see the gap. That's why candles are so effective, or bars are so effective. It's an empty range in the chart due to a big move in price, either up or down, because there was no transactions at that price. Now, lots of people get very uptight about this. This is typical slippage sometimes, when there isn't there's no counterparty to the price offered. So somebody's offering to sell you this at 101, but there's nobody willing to pay 101 for it. So you're only going to get 99 for it. So there's a gap from 101 down to 99. So there's a 2 cent, $2, $200, whatever it is, there's a gap. So that's what gaps are. It's all about balance, and that's what markets are. Remember, as with any market, whether you're selling this book, this iPhone, or this glass of water, you've got to have somebody that's prepared to pay the price that you want to sell it at. If there isn't, there's no market. And so financial markets are exactly the same. So we've got to have a counterparty, somebody that's prepared to pay the price that you're offering, or somebody's prepared to pay so the deal is done, and that's all on your brokers. Just bring those two parties together. Both parties, remember, will think that they're going to make money, lest they wouldn't do the deal, would they? If somebody bought this off me for €2 or $2 and thinks they can sell it for $4, he's doubled his money, hasn't he? Potentially, he might not get that. He might only get $1 for it. So he might have made a bad mistake. I might have bought it for 50 cents and I'm happy to sell it for $2. I might have bought it for $4, but I've got thousands of them and I want to get rid of them, so I'm selling them off. And that all comes into supply. It's simple economics 101, supply and demand. So gaps occur when there's no counterparty, there's no transactions at a price level. It's as simple as that, and you see it very graphically on particularly with candlesticks. And I think this is a great little chart as well. This isn't my original work, as you can probably tell. But basically, there's two types, obviously, isn't there? There's a gap up and a gap down. So gap up, this means there's not a surge in the opening price from one session to another. So it's very, I'm sure you all, hopefully you all understand what we're talking about when we talk about gaps. So gap up arises because large orders outside of the normal trading time have occurred. So this is session one, whether it's the end of a day, whether it's end of an hour, whether it's end of an actual trading session, like the stock market in Japan closes for lunchtime. So they all go off in Tokyo and go off and have some nice lunch, and then they come back and it starts again after lunch. In the UK, the stock market opens in London, the FTSE opens at 8 o'clock in the morning, same in Frankfurt, and it closes at 4:30 in the afternoon. That's the close of the day. So the open of the day, that's the opening price, isn't it, with a candle down here. The closing price, if this was the daily candle on the FTSE 100, would be here on Friday night. If there'd been some significant news over the weekend, which is typically when gaps occur on the Monday morning, this has been a positive move, so something positive. So we've gapped open. So from the close here to the open on the following session is a big old gap, and the gap is also between the high and the low of the actual session as well. So there's a big gap on that price. That is showing there is more demand for this thing, whatever it is, whether it's the FTSE, whether it's gold, whether it's Bitcoin. And there's lots of buying interest pushing it higher. So it's always, that's interesting, This occurs quite often when you've had a good announcement from a company the night before, after the market's closed, and it can move up. Or, the announcement's happened during the day, market has moved up, And there's more interest and more analysis gone on overnight, and it's gapped again the following day. It's much more typical when the market is closed and the announcements occur after the market close, and we move up or down if the expectations have been exceeded or missed. Obviously, a gap down would be the reverse of this, but we'll see that in simple terms as well. So we've got the buys are very much in demand. The gap down is the exact flip of that. So this session here could be the 4 o'clock candle, and this is our 8 o'clock candle. So there's some news that's happened around that time. Could be the market closing or the session closing. It's like when you're trading on the live futures market. When the session opens and closes, the live commodity markets, we get lots of gaps on that market as well. And it's here we've got more sellers than buyers. The exact flip of what we just said about going long. Everybody's trying to sell it, everybody's trying to get out, so we're moving down very quickly. And as you can see here, from the close of the previous session to the open of the next session is a big move down. The price was only fulfilled, people only got their sell orders filled at this price, whereas the session before they were getting filled at this price. So there's a big move down. Something's happened, positive, probably negative for this particular asset. So we've moved down. So that's all gaps are. But graphically, candlesticks and bar charts show it very, very clearly, and that's what we're looking for. And there's different, and the gaps that occur on the market can be catalogued and into different positions. Adnan, good afternoon. I hope you're well, or good evening. I hope you're enjoying your Eid holiday and things are well with you and your family. So thanks for joining me. So gaps occur because 4 key things typically. Liquidity, all assets, but it's rare in FX, I've written there. So basically liquidity, if there's no there's not enough of the stuff going around. So if people are trying to buy these things and a particular stock and there's not enough available, the price will move up until they get a price they're happy to offload it at. But very, very rarely, because of the liquidity in the Forex market, this global 24 hours a day market, a bit like the crypto markets can be a little bit like that now. Certainly the major ones, we seldom get gaps, but certainly in fixed assets like commodities like oil and timber and lumber and stuff like that, you can get liquidity issues. The most aggressive ones tend to occur in individual stocks, equities. They occur in stock markets as well, the indices, but more importantly, they'll occur in equities, particularly around earnings announcements. So particularly in the US are obsessed with their quarterly earnings. So every 4 times a year at the end of the first, second and third quarter, so typically 2 weeks into the next quarter, the announcements will start to occur. Companies are obliged to tell the stock markets how they have done in the previous quarter. So for January to March, second week of April, how they have done for those first 3 months of the year, companies start to announce how they've done. So they'll either exceed or undershoot what the market is expecting, both some sales, revenue, their expectations looking forward. And if all of that is much better than the market was expecting, stock would typically go up. If it's much worse than they're expecting, stock would go down. If it's in line with expectations, it could go either way. And if there's a big surprise in the earnings announcement, like there's a new CEO or the FCO's, so the financial controller or the financial directors had to leave, or there's big downgrade in sales and expectations, that can move the markets as much as the actual numbers that come in for each quarter. So each quarter, and it's obviously a global thing, companies have to announce that, so there can be big surprises either way, and that's when we can get moves. The other key thing is both upgrades and downgrades. So what the market is expecting, again, typically but not exclusively about companies. So all through the year, each company will have a number of analysts, number of bankers analysing their books, poring over their accounts, speaking to the key players in the companies, executives, managers, sales desks, all that sort of thing, new announcements, and the assessment of that goes on continually, 365 days a year, 24 hours a day. So these are officially announced to the markets, and that has an impact on how people balance their portfolio. The other key thing within that is if companies get moved up from one stock market to another. So, for instance, here in the UK, we have the main stock index is the FTSE 100, the FTSE 100. We call it the UK 100. That's the UK's biggest 100 companies. If a company starts to do quite poorly and it's not in the top 100 anymore, it can get kicked out of the top league, and a company can get moved up from the next tier down, which is the FTSE 250. And similarly in the US, and all stock markets around the world all have this both upgrade and downgrade of companies into their major league. So that obviously has an impact on companies. So an announcement like that, it means that some big funds and big brokers that can only trade the FTSE 100, or only companies in the FTSE 100, are allowed to actually, they have an ability then to actually buy this company or show some sort of interest in this company simply because they've made it to the big league. It's like getting promoted into the Premier League, or getting to the World Cup as a small country. So they've expanded I'm talking about World Cup, I'm talking about football now. The Men's World Cup has been expanded, hasn't it, recently? We're going to the US next year, but there's more countries being invited to take part. So it's a big upgrade for the football in that country and in that region. So earnings, upgrades, downgrades, announcements, all very, very important, and that causes shocks to the market, and therefore we get gaps, and it bring that there by default it brings interest into the position. So gaps are quite interesting. This is just some examples I've got here. This is liquidity gap. Cotton, again, I didn't mention cotton, I talked about lumber dye, but you get these moves in the market where the closing price here, the opening price of the next session is much, much lower than the closing price of the previous session. It might be a liquidity issue. We don't really know. That says highly liquid market. We don't really know that's caused that, but you can see the gaps all over on this particular chart, that here and here, particularly here at the end as well. So it's either low liquidity, high liquidity. Those can come in and sometimes can explain it. Obviously, something like cotton or corn or some of the more of the agricultural products, they're quite seasonal as well. So bad weather or expectations of bad weather again can have an impact on the harvest and on the yield. There could be a particularly a particular bug going around, hits cotton. Could be a big demand for a particular type of cotton, quality of the cotton. All that sort of stuff has a huge impact on commodity prices and the liquidity, therefore, of it. Obviously, you can't suddenly produce a bundle of cotton overnight. You've got to plan for it. So it's all that sort of stuff. So hence the supply and demand issues that go on all the time. So liquidity is key. Obviously, I know a lot of my colleagues, in parts of Africa, focus on the particular product in their country. So my colleagues in Ghana, for instance, Ghana is a huge producer of cocoa, massive world percentage of cocoa, big cocoa farmers. And obviously, again, you can't just produce that overnight. Similar things with like bananas and other products. My colleagues in Kenya, cut flowers is a huge market for colleagues in Kenya, and the coffee market. Obviously, Kenya is a huge coffee producer as well. So again, all these things are impacted by all sorts of things, from the weather to pests and diseases to demand from all different parts of the world and where you process all this sort of stuff. But fundamentally, demand, liquidity is all very key. And if there's high demand, not enough of the stuff, obviously the price goes up and we can move it very aggressively. And explaining that in the charts is where we get our gaps. Okay, earnings announcement, much more typical. Netflix, one of the darlings of the stock market over the last few years, shares tend to jump all over the place. Tesla, Apple, Netflix, obviously Nvidia's the current daddy of them all, and we can get these massive moves. But here, this is an example of an island gap as well. We've gapped up to the upside. Now we gap down to the downside as well. So I'm not sure if this is it's the hourly chart. So this is obviously end of sessions here, but you get that all the time on individual stocks. You just got to be careful what's going on. Tesla, we're going to shoot. I thought I knew I had a Tesla one. I don't know how old this is. This is from this year. I thought it was further back than that. But yeah, I don't know where we are now with Tesla, but look at this, all over the place. Again, daddy of them all. Lots of people turned against the company and its CEO. A lot of it for political reasons, but obviously the competition is hottening up quite significantly as well. But you can see here on this particular chart, you see how the volume bars as well can be used. This is a huge gap up. On big volume. So we followed through and it gapped again, sold off a bit on low volume, but the demand continued to move up. So gaps can be important. We'll go through all the different types in a minute. I'm just using these as just a couple of examples. So we have 4 classic gap classifications. I can't say that very quickly. Let me have a quick drink of water. Classifications. Any questions, guys? Or ladies? Samuel, Vinuk, Andan, please let me know. So common gap, breakaway gap, which is really sexy, and that's a big one. The runaway gap is an extension of the breakaway gap, and the exhaustion gap is, as you might expect, we've run out of steam, we've run away. And the 5th one is the isolation gap, or the island gap, which we've sort of shown a quick demonstration of as well. Right, the one that happens most of the time is the common gap, and you do see that quite a lot, as I say, particularly on a Monday morning, if there's been some significant news, or even if there hasn't been any particular news over the weekend. It occurs a lot, therefore it's perhaps less important and often gets filled. The key thing, like we just saw with the Tesla chart, if the gap is not supported by a significant increase in volume, obviously both upside and downside, we're talking about gaps generally now, I'm not talking about up or down, it doesn't matter. You've got to have the momentum supported, so volume gives you that. So typically, this isn't, again, this last point I've got on there, this isn't a given, but typically a gap is typically closed within 5 candles of the gap occurring. So I've talked about day here on the daily gap. So, but if you see a gap on an hourly chart or on a 15-minute chart, typically you want to be looking for the gap to be closed within 1 to 5 days. And that's similar, although not exactly the same, as looking at when you're identifying candlestick patterns. So a candlestick pattern typically runs out of steam once it's confirmed, whether it's a 3 candlestick pattern or a 2 candlestick pattern or a 5 candlestick pattern. Once it's confirmed that it is a morning star, it is an evening star, whatever it is you're looking at, typically the direction it typically runs out after 5 candles thereafter. And same with the common gap. It tends to get filled. You hear that phrase all the time in the markets, don't you? Or the gap it's always going to get filled. So as this has occurred here, let's just go back a step. Also, we don't know what's going to go on here, but as this occurs here, we've gone up and then up. People still buying there. Luckily, somebody might have shorted it all the way up here, and assuming that, or expecting the gap to get filled, and indeed it did. And again, here within 4 candles, we've had another gap here, haven't we? And it's filled instantly on the following day. So the gap. Again, let's just go back to the gap. The gap can be from as we saw on the top slide. I didn't actually mention that. Let me just go back a second. The gap has to be to be. I'm going the wrong way. This goes back to the gap has to be between the absolute of the 2 price actions of the previous session. Obviously, the more significant the gap between the close price and the opening price, the more significant the gap is. Even if these tails, these wicks on the candle were much closer, the gap between the opening and closing price is the key gap to look at. So even if there was no wick here and no wick here, that the significance of that gap is higher because there's no trailing price here, and there's no extended price here. That makes that gap even more significant. So the bigger the gap between the bodies of the candles, the more significant the gap is. I should have mentioned that at the beginning. Same, and that's obviously the same whether you're going short or going long. So the distance between the bodies of the candles is more significant than the distance between the wicks. But there's got to be a clear, fresh air between the lower wick and the here, in this case, the lower wick and the upper wick of this second session here. So that's the key rule. But you normally tell by the distance between the bodies of the candles as well when you see them coming. Okay, sorry about that. So yeah, so just going back to common gaps, you can see here the gap was fairly significant. There's no down wick on this particular one. Within 2 sessions, we more or less filled the gap, hadn't we? Took 3 sessions to actually fill the gap completely, but that's been filled. And so typically, if it's not filled within 5 sessions thereafter, of the gap occurring, we can have some significant moves going on. It was a gap up, it cooled initially, didn't it? But it's a leg up, then it's retraced, but then we've moved up in a more steady manner with smaller candle patterns. You would smaller candle bodied sizes, but we have ticked higher, move higher, and then exhaustion up here, and we got a new high, but then came down very quickly, didn't we? Is what we're seeing here. So this move up is perhaps just cooling a wee bit on that. So common gaps are filled fairly typically, and it's usually around some key levels. So as the drive, this is again, this is leg down, retrace the leg down quite significantly, bounce quite significantly here on the third bounce, retrace 3 days again, or 3 periods. So this is the daily time frame. So three consecutive days down, and then bounce quite aggressively on the 4th day, then gapped on the 5th day into the 6th day, but run into a key resistance area where we'd found resistance before. You see the resistance line here. I'd have had it here at the bodies of the candles rather than the wicks, but you can see the selling. Remember what wicks are to the upside. They're rejection of higher prices, rejection of higher price, and it's come down, rejection of higher price, and it's actually finished low this time. We moved higher, but we closed here. Then we resisted. Then we moved higher to that same area again, but came to move down. So again, a gap here, probably over the weekend. This one, can you see it's gold on the daily time frame? There's no gaps here. Probably a Friday to a Monday, moving higher. Final buyers exhausting at this resistance level, which had been identified earlier, and then we moved down for the rest of the week, and perhaps we had a big up Friday here if this indeed was a Friday to Monday. Probably was with gold, and then you see the low level being established, and then you see the top of the candles through here, top of the wicks through here. So wiped out, of no significance really, and we've got a sideways action, haven't we? So from a trend down to a bounce up, and then we've got sideways consolidation going on with a gap thrown in for good measure. And you can see here we've got up days, down days, up days, down days. So there's a lot of chopping and changing with no direction, with support and resistance areas identified horizontally on that particular chart. A more interesting gap, and one I'd like to trade, are breakaway gaps. So solid gaps break away from important levels, such as that resistance and support levels we just identified on the last chart. Okay, so for instance, on this one, we're looking at a breakout of our channel. We've been moving up quite nicely, higher, lower, higher, so higher highs, higher lows. So we are moving up quite nicely, and then all of a sudden, bang. Again, whether it's a weekend or not, we don't know what it is. Doesn't matter, does it? Again, that's the other thing with gaps. It doesn't matter what the asset is, but if you know the asset, if you know that that's the cotton market, or you know that that's the cocoa market, and there's been a big announcement about at the end of the quarter or at the end of about some major producer of whatever it is, copper, gold, some miner, some whatever it is, country can't produce cocoa anymore, or iron ore has been processed, has found a big new discovery in Australia this week. They announced it on iron ore. So whatever it is that's causing it, that's a big move away. That's a huge gap. So it's not a normal gap, and it's broken the structure, hasn't it? This nicely moving chart that's been moving up and down here, nicely up and down, bias to the upside. So we've probably been long here anyway, but that's a big surprise. There's been some big demand for this asset that's shot up initially. It's cooled on that first session. It's gone down again, sort of consolidated a new level here, went down again, didn't want to go anywhere near the previous price action, way out of its channel. That is a breakaway gap. That is the one you want to get onto, and trade it accordingly with your stop loss. Initially perhaps at the previous high, but we're now into the next level. We've changed again. You get breakaway gaps when we get a re-rating of the particular asset. So a company, an asset could all be re-rated by the market, and we're moving into new levels, or we've broken a key level. This could be the Forex market, this could be the cable, and we've suddenly broke through 150 against the dollar, or we've broken through 110, or we've broken back over parity or something to the euro. So we've some pattern, some chart formation, whether it's a wedge, whether it's a channel like we've got here, or it's a flag or whatever it is, we've broken out. So we get breakdowns of what we've already got set. So it's a big move and it's a surprise. They're the ones you want to be on and just run with it as it goes. So we've had a big gap up, retrace down, but we're moving high, and that's suggesting more energy to the upside. So breakaway gaps again don't happen a great deal, but when they do, they move, and they move very, very strongly. I know lots of people that trade that scan and trade stocks look at this type of pattern, look for consolidations and looking for breakouts. The problem with them, some of the breakouts, well, quite often breakouts fail. That's a deliberate move by some of the market makers. The problem with when you're trading stocks, guys, is sometimes there can be not only a lack of liquidity, like we said earlier, but also not many market makers for that particular asset. So unless it's a big blue chip stock, so something outside of the FTSE 100 or the S&P 500, any sort of second division stock, if you like, that market can be captured by particular players, whether it's banks or fund managers looking to fill a position or offload a position. So you've got to be careful on smaller positions, especially with, we go all the way down to penny stocks. Be very, very careful with penny stocks that seem to have gone up 1,000%. Very, very liquid, very difficult to get rid of once you've got hold of it. Take it from me, I've been there, I've done all that. So be careful. It seems too good to be true, as ever, it usually is. So be careful with that sort of thing. But if you see this sort of setup on any major asset, whether it's a Forex market, whether it's a commodity or a stock or an index, these can be very powerful to trade. Obviously, that was a positive. This is a negative one here. You see we've been moving down here. We've got a bearish, significant move down, but then we start to move up. We got in our channel, we got a bearish flag here. So we thought higher lows, we got higher highs, and then all of a sudden the pattern is broken, and we're down to the other side. So the gap needs to be considered because it could be a strong bullish or bearish signal. It often, and that's the beauty of gaps, and that's why lots of people take action as soon as they've seen them, rather than wait for confirmation, and then with a small position, and then add to the position as the breakaway gap is confirmed. So it's often, as it says there, that second bullet point, it's often the first sign of a further major move to going. So the players, or the inside players, the inside knowledge will have been selling up here and selling here. The news might have broke over the night or over the weekend, or at 11 o'clock or 12 o'clock, whatever this might be, and the rest of the market gets in here and we move down instantly. Those that have got in, those that have been selling up here are getting out down here initially, so the price drifts high, and then the rest of the wider market gets a sniff of it. They resell up here and we move down again to the downside. So again, a very significant move is quite often anticipated or is expected when a correctly identified breakaway gap. Again, stick your volume chart on there. Again, volume in the derivatives market is going to be very difficult with Forex, but you can still get some sort of idea anyway that can help you. Yeah, I mean, Adnan's just put a really good point here. I'll just put his question. Usually we miss this trade if we wait for confirmation. Absolutely, that's what I'm saying. That's what I just said, Adnan. You're absolutely correct. You know, this is a very, I mean, look at all the candles that have created this. So there'll be lots of bulls in here because we've got a nice pattern. We've had a shakeout and looks like we're moving up. We didn't get to the previous high, but we were forming higher highs. We were forming higher lows. This was moving up quite nicely, and also bang. So you act initially and then see how it goes. So again, you know, add to the position as the price drifts back up. But very good point, Adnan, indeed. To the upside. So breakaway gaps, very powerful. A breakaway gap and then a different type is this runaway gap where a rally just runs. You know, and the runway is just a continuation, if you like. So, and again, it's not a breakaway. It's just the market is already moved. We are moving. There's a gap in the so it's just adding to the momentum. So we have again, your momentum indicators can help you with a runaway gap. It's just a continuation, if you like. It's a continuation trade rather than a trigger trade like we have. Sorry, going back the wrong way. A breakaway gap tends to be an initial burst. A runaway gap is a continuation trade. So if you've missed out on this first break here, or you've missed out on the break above this consolidation here as this has moved up, you see this gap to the upside. Obviously, at this point, it could easily be just a standard common gap, and then we could move back down here, but we didn't. We consolidated, and then we gapped again, interestingly there. Did get filled this time, but we didn't move back to fill this gap. So we've broken away. We've broken to the next level. We've gone up a step. If you think of the market moving up in steps rather than or you know, we talk about waves all the time, don't we? Rather than a smooth move up, we've stepped up. We've gone to another level here. You know, so the intensity has increased, and that's what we're looking for. And you can see here towards the end of this example here, we see the bigger body size of the candles on this as this moves up again, and there still seems to be lots of pressure in that. Or this, obviously, this is a live example, but you can see, you know, the angle of the move is quite common. It's similar on both patterns. We've had a breakout initially. We had another breakout which coincided with a gap, and it's continued the initiation that we started down here. Excuse me. So we, again, stick your volume on, see if there's increases in volume. So this is like the continuation trade, whereas the breakaway gap is the initial a spurt to get in on the move to the upside. So that's number 3, the breakaway gap. Number 4 is when this massive move or a move, continuation move, is running out of steam. So whether we're moving down, all these examples have been up, haven't they? But you know, obviously flip them, just turn them on the head for selling positions. So sometimes it's the final flurry of buyers. Again, that is often in strong trends, like we've got this example here. Often that can be identified by candle patterns as well. There's obviously all sorts of different types of candles we're looking for at the top end of a move. Like we've got here, we've got hanging man here, but it also coincides with a gap up to the upside. So it's a final flurry of buyers. So somebody has missed out on this a move, or teams have missed out, or traders have missed out, the old fear of missing out. And here we go. We're still people buying up here, but let's force that gap to the upside. But that is it. You know, it's over. Sign of fatigue. You know, a big long rally. It's been going on for a while in the same time frame. We're getting to a key price level. Perhaps it's a big round number. It's just an exhaustion of this move. It might mean this could be a daily chart. It's been going on for months here, or potentially months. It could be weekly candles. Whatever it is, you know, there's signs of fatigue as we get to the top. We got consolidation at the top of a move. It's still positive. I'm a big fan of, you know, buying at the top of moves. It's not a problem, but obviously that would be a big caveat. This gap to the upside, filled again. See how it's been filled? Oops. See how it's been filled within 2 or 3 days here. So again, it's a big gap. It's also a consolidation exhaustion gap as we've come down. But even after 1, 2, 3 days, it was okay. But that's a big candle down compared to the rest of the candles in this consolidation at the top of the chart. And then we break out and move down quite significantly. So we've had 2 big significant red candles, or 3 or 4 big green candles have been sold out. It's still okay at this point, to be honest, but you can see this level. If we break from here, if we have break from here, we've had 2 level series of steps of consolidation here. We could move down quite aggressively into this level. Your next support is this level here, isn't it, where we had some sort of congestion here as well. So volume should be thin here as well. That's also a good sign. There's not many buyers. There's those that are really desperate to get in on this trend that have missed out, and it's there's not many serious buyers. There's not much big volume. So what you're looking for an exhaustion gap is thin volume as well, and that is suggesting that demand is cooling, demand has run out. It's just the last desperate buyers are in this one, and it's that that's still moved it higher, but we haven't. We've actually finished lower in these 2 positions, although significantly higher than we were at the 3 previous sessions. So we are down. Exhaustion gaps also very, very key at the turn of a market. It's obviously other indicators on here. You could have a pivot point turn. You could have had all sorts of other patterns forming in the candles themselves as well. So exhaustion gap is exactly what it says. The move is coming to an end. And finally is an extended exhaustion gap, if you like. We call this an island reversal. After the exhaustion gap occurs, a gap occurs in the opposite direction. So the candle or a few candles get cut off. They get isolated. They have an island. So we have a gap up and then a gap down, and that is a real strong sign. And once you get that, you can have a significant reversal of the price action. So again, wasn't so much a strong trend. This is quite a nice trend. Then we consolidated up, consolidation zone, up level. So that was all fairly standard stuff here. Trend, consolidation, trend up, consolidation, trend up. Just that this final leg here, the angle of the increase was getting a bit steep, wasn't it? On the flip side, from a positive point of view, the size of the green candles were quite significant. They're quite a move up. But again, there's lots of buyers in here. And again, we got a bit of exhaustion here. And then the gap down, that would be your first head of, oh, hello. 3 or 4 sessions looked like we might be holding this level, but enough. And then the 5th session, we broke down. And then we've broken down quite significantly back again into this support area, which was previous a resistance area here. So quite a move, and you can often get that. This example is gold. You get that on the commodity markets quite a bit as well. Oil, gold can do these, display these forms of move. And again, obviously, the Friday to the Monday can be key as well on these markets as well. So obviously, because of the news over the weekend, obviously it happens from on daily charts overnight as well, as I say. But don't rule it out either on the lower time frames, the 4-hour, the 1-hour candle frames, particularly when with some significant news going on as well. So 4 types of gaps we've looked at today. The most common is the one that occurs the most, and we rule it out because it's filled quite often. The breakaway gap is the most exciting, potentially risky because it can be filled quite quickly as well. But usually it's a big confirmation, and obviously the bigger the gap between the bodies of the candles, the more significant the move can be, and the follow through can be very significant, both up and down. The runaway gap is a continuation of a move, a trend typically. So if you're in a strong trend, you get a gap within the trend. Don't get freaked out by getting out just because we got to new highs, just because it's gapped high, it's going to get filled. Didn't happen, did it? We continue to move higher. So stay in the move. And then what we do get though, from a gap analysis point of view, is when the trend is coming to an end, whether we're trending lower or trending higher. we run out of buyers, or we run out of sellers. We've exhausted all the move, and that is displayed in the exhaustion gap as well. And so we continue to move up or down. So, and then finally, the island reversal, which we can obviously occur at the end and at the end of a trend. Whether in this example we're going up, we can have it the other way around as we continue to move down. But we do get an overextended move. We get this isolated price action, and the bounce or the move down can be very strong indeed, a very significant pattern. It is in when it's been identified, but the key is identifying it and actioning those particular moves. So they're the key 4+1, if you like, patterns. Best typically on markets that close, so equity markets, individual stocks, gold, oil, markets. If you've got a derivative account, they tend to smooth all that out. But we do have. Sorry, let's go back to here. You do go, but at the end as markets are closed, you look at the updates. So check the candles on the close of the days. So I'm just going to just bring in the live markets. I haven't actually found any gaps actually today, but let's have a look, see if we can identify anything that's going on currently. So let's just see what's going on. So again, because of the nature of typical derivatives markets, you tend not to get them. So this is the 4-hour time frame on gold. Let's go up to the daily time frame. It's a bit easier to identify because of the weekends, but you can see what tends to happen with chart supplies is they tend to smooth out the differences. There we have it. There's a gap there, isn't there? So a gap down here on the 22nd of April here on the gold market. We've moved down. We closed lower on the day. Next day we bought it back, but we haven't filled that gap, have we? You can see the intraday price action has sort of filled the gap, but the bodies of the candles doesn't get filled or doesn't return to anywhere near that for 10 trading days. So we consolidated following the move. We moved lower. We found support. It happens to be at the 20-day moving average here, and then it moved back up, and then the gap was finally filled here on the 6th of May. Then it's moved down, but again, it's very much a sideways action here, isn't it, on the gold market, and not very many gaps there. If we go to the stock markets, so they're perhaps easier to identify. Trades panel. What trades panel? I want market orders. So let's go to the stocks. Let's look at oil and gas as well. Oil can occur as well, but again, see this is the daily chart, and again, it's a much more of a smooth pattern. But you see the body candles there was the gap, but the wicks here, big move down, but the intraday not really a gap, was it? And then we moved up, so big move down, retrace into a key. Next move down, was a gap low there, but see instantly again common gap here between the wicks, the lower wick, the upper wick, the bodies of the candles. Quite significant, isn't it? This is the announcement from, again, you see that's a Friday to a Monday, so that was the 2nd of May to the 5th of May. It was also the beginning of a month. That's another key thing. We've had a technical closure there on the 30th of April. A new month starting there. Then we gapped here on the Friday to the Monday. It was immediately filled on the Tuesday, and then we moved higher through the 20-day, but couldn't get to the 50-day. Then it's gone sideways, and then we've drifted back up. We've had a strong week for the oil market so far, and we're actually over the $65. So that gap down was filled instantly, so no big deal. But instantly we did move to $55, and it was a big old low that was bought, having breached the key $58 level, which had been support for the 3 previous days before we tested lower. And again, this typically is not untypical for these things to happen. So again, you see it's not occurring very often, and it hasn't played out there because it was bought back straight away, and we've continued to move higher, and other indicators suggest we are moving higher there on the oil market. Indices, because a bit more because of the nature of indices, but again with derivatives, because this isn't the actual cash market. This is a derivative. This is our USA 30, a derivative of the cash market, so it tends to be smoothed out a bit more, but you still get them here again. So here, that was the 22nd, and that's the 23rd. That's not a weekend, but that's from the 22nd of April to the 23rd. There was a gap from the close. Strong day. Obviously, we'd moved down for 4 days though. Into the low. We didn't get the 8th of April low, these buyers. So this is the second phase of the buys, if you like, on the 22nd of April. And then it fizzled out a bit on the 23rd and then followed through the week thereafter and continued to move higher and above the moving average, the 20-day moving average, and then rallied to, found resistance at the 50-day moving average before moving up, and then there's another gap there, wasn't it? This is more of a breakaway gap. Sorry, a breakaway potential, a runaway gap. So we moved higher, and then we created a new, bought back to where we were at March here at the middle of May. We had retraced a wee bit, and now today, this week, Friday, we went into this area here, and then we sort of sideways action yesterday, and again sideways action here today. But there you see the gap being put a positive to the upside, and it was filled. Again, see, it wasn't filled, was it? So this is much into play. So the 20 period moving average has been into play there, as well as the gap there on the S&P. This is the Dow. So similar things in Europe. The DAX obviously do a similar thing. So we've had a gap here again, 22nd to 23rd, gap from the close of the 22nd to the 23rd, and it's run away, hasn't it? It's much more of a positive move. Added to as we broke through the 50-day moving average. Big candle here by the 2nd of May as we've moved into the new month. We've moved higher, bit of a retrace, but the 20-day is now providing is our support. New all-time highs earlier this week, and now we've cooled the last couple of days, but the trend is moving up from this, the gap, last big gap was here on the 22nd of April. So that's added to our runaway position there on the DAX. We tend to, we've still got a few 10 minutes left. So NASDAQ, so with this obviously similar move, more exaggerated with NASDAQ. This is the NASDAQ 100 as well, remember, so it's even more exaggerated, there's less stocks. But again, similar big gap here from the 22nd to the 23rd, and a big follow through there on the 24th for the NASDAQ as it went through the 20-day moving average. A few days later, we were through the 50-day moving average. We moved higher, another gap here from the 9th to the 12th. So this is a Monday to a Friday. Sorry, Friday to a Monday gap, weekend gap moved through. But interestingly, we haven't had a candle as strong as the 12th of May. Since then, we've rallied, cooled, and it looks like it's running out of steam, but it's only because we're back to where we were, back to testing potentially all-time highs here on the NASDAQ, and all of that. Again, two gaps on the this was within the week, the 22nd to the 23rd, and this is the weekend gap. So they're important, guys. They watch them, trade them, keep them on your side. Remember what they're telling us. They're telling us here with gaps to the upside, there's many more buyers than there are sellers. So the momentum will follow through. I haven't got any volumes on here, but volume is obviously also key to add to your trading the gap position as well. So really useful. I mean, again, the other way to trade gaps, guys, is on a intraday basis and see where we finish and see if there's a gap on the particular morning. So look at the stock market. Let's just go back to the FTSE. If we're looking, if we go down to this is the daily time frame again, but if we go down to like the 5-minute chart, you want to trade this on an intraday basis. You want to be looking, particularly if you're using our charts here. You want to be looking at what's happening at 8 o'clock when the actual cash market finishes. So that I'm guessing. See what's happened there? That's remember, this is just a 5-minute chart. What's this? This is a 16:30. Why is that significant? That's the closing bell of the UK stock market. Big volume on the day. So that's the close of the day, if you like. So we just put a line on there. So again, if you can trade the cash market. So that's the close of the day. If we go back to 8 o'clock this morning, where are we? 8 o'clock. 8 o'clock, 8 o'clock, 8 o'clock. It's this one here. Again, you see the size of the candle. So again, we put that as the 8 o'clock candle. So we were trending pre-market. We were trending how we did do that, into the first hour of trade, and then we give it all back there at 9 o'clock. A 9 o'clock candle give a lot of it back. Obviously, the data this morning out of the UK was at 7 o'clock when the jobs data showed more weakness in the UK jobs market. That's weakened the stock market. It's lifted it lifted the stock market, I should say, and we continued. We moved higher, and then we moved higher all the day. We got the high of the day up here, and then we've moved down from that, and then we moved down significantly, closing out at the cash market there at 16:30. So if you're going to do that, trade on an intraday basis, be aware of what's going on pre-market. Be aware of the opening cash session. Always mark that up like I've done here, and then investigate what's causing some of these big candles. But obviously, with the slower time frames, gaps are much less clear and much more difficult to identify. But again, if you want to use it that way around, same with the DAX or any of the stock markets, mark up the opening and the closing of the cash session. Obviously, we offer you prices throughout the 24-hour trading day from Sunday night to Friday night. So that's stocks. So there we go. That was time's nearly up. If there's any questions, let me just move that down there out of the way. Hope that's a example is good enough and makes sense to everybody. And there we go. So we've looked at what is a gap. We've identified the types of gaps and why they occur and what causes them. We've classified the five gaps we've talked about, and we're using different indicators to provide our support and resistance areas. I haven't actually used them in pivot points, have I? It's me from a previous presentation. But we've used our areas of support and resistance and other technical indicators, whether it's the size of the candles, moving averages, big round numbers, horizontal levels, for giving us our explanation of our gaps and taking action. Remember, the breakaway ones are the key ones we want to be looking for. Add volume to your charts to really benefit from those. So thank you for your time today, everyone. I'm a little bit ahead of the terms. So what's Adnan telling me here? Adnan saying Island Gap dollar D1 12th of May. Yes, I'm sure. Well, let's just do that as Adnan's found that for us. Let's have a look at pros, the dollar yen on the daily. Let's bring this up for you. It's an example. He was saying, what was his end? The 12th of 12th of May. Oh, indeed. I mean, again, we do get gaps on in the forex market. I didn't mention this. A lot of it's obviously to do with what the central banks are doing. So 12th of May. What's the 12th? Yeah. So there's that fry. It's it's technically the body of the candle, obviously, but the intraday price action. You see that has closed that down. It's not really a gap, but it's followed through, and then it's taken. So this 3-4 day rally, 3 strong candles, hesitation for 1 day, but then it took 10 days to sell it off, and we're back to the lows here as well. So dollar remains pressured, although we're back to 145 at the moment. Still historically very, very high against the dollar yen, against the yen. So, but yes, thanks for that. And yes, I question whether that was actually the sort of gap we're looking for to feed through, which is why it wasn't. You could argue why it didn't follow through. It was a strong move up here on the 12th from the Friday action. So the Friday we closed lower, we opened much higher, and we've closed the Monday much higher. But by Tuesday, Wednesday, Thursday, we were back to where we were the previous Friday, weren't we? And a whole week later, by the 16th of May, we were back to where we were the previous Friday as well. So yeah, always bear that in mind as well. But Adnan, thank you for that. It's only it's not necessarily lining up, but anyway, thank you for that, and thank you for your questions, everyone. Tomorrow we'll be live for the US CPI announcement, which comes at it's normal US time, isn't it? So it's I'll be live here from 12:15 GMT, Universal Standard Time. Just finished with the list of the books. ThePropTrade.com is us. If you haven't got an account with us, why ever not? We are here to help you, my friends. It's a great way of getting into trading, proving yourself as a successful, consistent trader, not losing too much, doing it on a consistent level, and real funds can be available. So thank you for your time tonight, and take care, be safe, and I'll see you